Hey everyone, welcome back to the channel. In my last video, I shared a 1-year update on my dividend portfolio where I broke down how I built a portfolio focused on passive income and made some money. But today we're shifting gears because I've got another exciting update, this time on my undervalued stock portfolio. So over the past year, I've been running an experiment where I invested $1,000 every month into stocks I believed were undervalued based on strong fundamentals. I started on March 1st, 2024, and after 12 months, that's a total of $12,000 invested into companies I think have long-term potential. And in this video, I'll walk you through my strategy, the companies I invested in, how they're performing, and whether or not my approach is beating the overall market. So let's first start by discussing the investment philosophy I followed when building this undervalued portfolio. Just like with my dividend portfolio, I had a clear game plan to ensure that I was making smart and intentional choices. First, I only invested in companies I know and trust. So no risky investments, no meme stocks, and definitely not chasing short-term hype. I stuck to businesses I personally understand and believe in for the long term. Second, I made sure every company was undervalued based on at least 2 valuation methods. It's very easy to want to invest in stocks based on gut feelings, but I relied on real data like price to earnings ratios, discounted cash flow models, and other valuation tools to confirm that these stocks were trading below their true worth. But I wasn't too picky about choosing between value or growth stocks. Both were fair game for this portfolio. And just as a reminder, value stocks are companies that trade at a discount compared to their fair value today and are often well-established businesses with stock prices below where they should be. But growth stocks, on the other hand, are companies expected to grow faster than the overall market in the near future. They may not seem undervalued now, but within a year or so, today's price could look like a bargain. So by being open to both, I gave myself more opportunities to find great deals and maximize potential returns. Then, to minimize risk, I followed strict diversification rules. No single stock was allowed to take up more than 15% of my portfolio, ensuring that one bad stock couldn't drag down the entire portfolio. I also diversified across at least 5 industries to protect myself from sector-specific downturns. In addition to that, I wanted to make sure my portfolio beta wouldn't get too much above 1.5. And lastly, I focused on companies with a track record of long-term growth and stability, specifically companies with 5 or more years of consistent revenue or market share growth. This way, I was betting on companies that had already proven themselves, making them safer bets for the future. So with this overall strategy in place, I built a solid foundation for my undervalued portfolio. And now that you know the game plan, let's move on and take a look at the companies I ended up investing in. So over the past year, I built a portfolio of 24 companies that I believed were undervalued when I bought them. Let's quickly walk through each company that I own now and highlight a few that I managed to grab at a great price. You can also see all the prices at which I bought each stock in the table or the chart. First up is Adobe, which owns tools like Photoshop and remains a leader in creative software essential for content creation and design. Then there's Alibaba, the Chinese e-commerce giant that I managed to pick up at an incredibly low price compared to its historical valuation. Next is Alphabet, the parent company of Google, which was a no-brainer given its dominance in search, advertising, and cloud services. Apple also made the cut as an industry leader in tech and innovation that needs no introduction. I also added Baidu, another Chinese tech company often referred to as the Google of China. Boeing gave me exposure to the aerospace and defense sectors, while BYD company positioned me nicely in the electric vehicle space where it's emerging as a strong competitor to Tesla. I also grabbed Chewy, the go-to platform for pet supplies, and Chipotle, which continues to perform well in the fast casual dining space. Costco was another addition, a rock-solid retail giant known for its membership model and loyal customer base. I'm personally a huge fan of Costco and I'm a member there as well. I also picked up Disney, betting on its strong content library and streaming growth despite its temporary struggles. Estée Lauder, a global leader in cosmetics, was another stock I couldn't pass up at a discounted price. I also added Lyft, which gave me exposure to the ride-sharing industry at a time when I thought Uber was overvalued. On the fintech side, I invested in MasterCard and Visa, 2 dominant players in the payment processing world. McDonald's made the list as a reliable stock with strong global brand power, while Microsoft added even more tech diversification, especially with its cloud and AI growth. Nvidia was another must-have given its dominance in the semiconductor and AI space and was probably the most talked about stock of 2024. I also picked up PayPal, which was trading at a deep discount and still has massive potential in the digital payment world. Then PulteGroup gave me exposure to real estate and home building, while Shopify provided a way to invest in the growing e-commerce ecosystem. I also added Target as a strong retail player with a loyal female customer base, and Tesla because of its leadership in the EV market and potential for future growth. And rounding out the portfolio, I grabbed Unilever, a solid consumer goods company with global reach, and Visa that I've already mentioned when I talked about MasterCard. So with this diverse mix of undervalued companies, I positioned my portfolio to capture growth and value across multiple sectors. So now that you know which companies I've invested in, let's move on to see how diversified my portfolio really is. As I mentioned earlier, I followed a strict rule to make sure that no single stock took up more than 15% of my portfolio. This rule helped me minimize risk and prevented any one company, even a high-performing one, from dominating the entire portfolio. And after 12 months of investing, my undervalued portfolio is now spread across 24 different companies with a solid balance across my holdings. Boeing currently holds the largest position in my portfolio, making up 10.9% of the total, followed closely by Shopify at 10.8%. Disney also holds a significant spot at 7.9%, despite some challenges in the streaming space. Adobe comes in next at 7.6%. On the smaller side, some stocks contribute less than 2% to my portfolio, including Alibaba, Baidu, BYD Company, Costco, McDonald's, PayPal, and Unilever. The average dollar amount I've invested per stock comes out to $603, with a median of $510. The highest position value in the portfolio is $1,572, while the smallest is $142. This shows that I've kept things relatively balanced while allowing my best performing stocks to grow. And this approach helped me spread my risk while giving my winners room to grow, setting me up for strong long-term returns. But diversification isn't just about spreading my investments across different companies. It's also about making sure that I'm not too exposed to any one sector. For example, I could have invested all my money into only tech stocks, but if the tech industry takes a hit, I can lose most of my money at once. So let's take a look at how my investments break down after 12 months across sectors. Tech stocks lead the pack by a wide margin, making up 30.6% of my total portfolio. This includes major players like Adobe, Microsoft, Nvidia, Apple, and Alphabet, all of which continue to dominate their respective fields. And given how much innovation is driving long-term growth in tech, I'm comfortable with this larger allocation, but I'll still keep an eye on it to make sure it doesn't get too heavy. Then the transportation sector follows, accounting for 21% of my portfolio. This is largely due to Tesla, Boeing, Lyft, and BYD Company, which I was able to scoop up at undervalued prices. I personally have very high hopes for this sector as travel demand rebounds and as EVs and ride-sharing continue to grow. Then e-commerce follows closely behind at 18%, with Alibaba, Shopify, and Chewy leading the charge. These companies saw a lot of volatility over the past year, but I took advantage of price dips to build solid positions that I believe will pay off in the long run. Then retail makes up 8.8% of my portfolio, with strong names like Target and Costco holding down this sector. And despite ongoing challenges in brick and mortar, these companies continue to adapt and maintain their competitive edge. Entertainment is another key part of my strategy, accounting for 7.7%. This includes Disney, which has been navigating the streaming wars while also benefiting from its theme parks and content library. Financials make up 5.4%, driven by MasterCard and Visa, two powerhouses that continue to dominate the payment industry. And real estate, represented by PulteGroup, takes up 5.1%. I always like having some real estate exposure when I invest, and I would like to add more to this sector over time. And then restaurants are a smaller part of the portfolio, sitting at 3.4%, with Chipotle and McDonald's driving growth in this space. So while not a huge chunk, I like having exposure to brands that consistently perform well and adapt to changing consumer trends. So now that we talked about diversification, let's quickly go over another important risk metric called beta. So beta in finance is a measure of how much a stock moves relative to the overall market. A beta of 1 means the stock typically moves in line with the market. If the market goes up, the stock tends to rise, and if the market goes down, the stock tends to fall. A beta higher than 1 suggests that the stock is more volatile, meaning that it will move more than the market does, while a beta below 1 means the stock tends to move less, making it less risky. And for my undervalued portfolio, the weighted average beta comes out to 1.44, meaning my portfolio is slightly more volatile than the overall market. But that's not too surprising since I'm targeting undervalued stocks, which often come with higher risk in exchange for the potential of higher returns. And looking at individual stocks, Lyft, Shopify, and Tesla have the highest betas in my portfolio, all higher than 2, making them the most volatile. These companies tend to experience bigger price swings due to factors like innovation, changing consumer demand, and intense competition. But because these stocks have high growth potential, I'm actually willing to accept the extra volatility that comes with them. And on the lower end, BYD company, Baidu, and Unilever have the lowest betas, which means that they're less correlated with the performance of the overall market. And these are also non-US companies, which may explain why their beta values don't perfectly align with the US stock market. However, these stocks add international diversification to my portfolio, helping me balance out the higher risk positions. So overall, I'm not too concerned about the higher average beta of my portfolio, as it perfectly reflects my focus on growth and undervalued opportunities, but I've balanced it with enough lower beta stocks to cushion against market swings. And this mix allows me to pursue higher returns while mitigating some of the inherent risks that come with volatility. And now let's talk about how individual stocks in my portfolio have performed over the past 12 months. Chewy has been the standout performer, delivering an incredible 121.3% return. My $387 investment grew to $857, giving me a solid $470 profit. This was actually the best undervalued stock that I've discovered on my journey. Shopify also delivered exceptional results with a 79.8% return. My $872 investment is now worth $1,568, adding $696 to my portfolio. And Shopify continues to dominate the e-commerce space, helping businesses become successful online, which has clearly driven its strong growth. Tesla had a fantastic year as well, up 70.2%, adding $242 in profit on my $344 investment. Elon Musk's company has definitely innovated a lot, but I think that his involvement in presidential elections also ended up helping it. And similarly, BYD company, a growing competitor to Tesla in the EV market, posted a 67.2% increase, turning my $116 investment into $193 and adding $78 in profit. And on the downside, a few stocks saw slight declines, but none of them were very concerning. Adobe saw a small decrease of 5%, resulting in a $57 loss on my $1,153 investment. And despite this dip, I'm confident in Adobe's long-term prospects as a dominant player in the creative software space. Microsoft dropped by 3.4%, leading to a $21 loss, but given Microsoft's ongoing leadership in cloud computing and AI, I also remain optimistic. Pulte Group experienced a 6% decline, which amounted to a $46 loss on my $769 investment. Target also saw a slight decline of 9.6%, resulting in a $40 loss. But despite these minor losses, the overall performance of my portfolio has been strong, with significant gains in several key positions. And this reinforces my strategy of focusing on undervalued stocks with solid long-term potential. So now that we can see the individual stock gains and losses, how has my entire portfolio performed after 12 months? Let's break it all down. So with a total investment of $12,000, the current value of my portfolio has grown to $14,472, which represents a 20.6% return on investment. This is a solid gain and makes my strategy of finding and investing in undervalued stocks quite successful. Out of the 24 stocks in my portfolio, 20 showed gains over the past year, while only 4 experienced losses. In terms of percentage profits, Chewy delivered the highest gain with a 121.3% return. And in terms of dollar profits, Shopify gave me $696 in profit. On the flip side, the highest percentage loss came from Target, which dropped 9.6%. The highest dollar loss was Adobe, where I'm losing $57 so far. So to put things into perspective, if I had simply invested the same $12,000 into the S&P 500 consistently over the past 12 months, I would have ended up with $12,948, which translates to a 7.9% return. So my undervalued stock portfolio outperformed it significantly with a 20.6% return, adding $1,524 more than the S&P 500 would have. And it definitely performed better than if I just simply kept $12,000 in cash. So in summary, my portfolio has delivered strong results, especially when compared to a broad market index like the S&P 500. Despite a few minor losses, the gains from some high-performing stocks have more than compensated, contributed to a solid overall performance. And this proves that my approach of carefully selecting undervalued stocks while also maintaining a diversified and well-balanced portfolio worked well over the last 12 months, and I'm hoping it will continue working in the future.